What if I told you that a single, boring investment made in 1990 could have grown to over $1 million today? Not through risky bets, not through crypto, not through luck, through dividends. And a principle so simple, it almost sounds too good to be true. This is the story of the dividend snowball. Here is what most people get wrong about the stock market. They think wealth is built by buying low and selling high, by timing the market, by finding the next big thing before anyone else does. But the data tells a very different story. Since 1960, dividends have accounted for roughly 69% of the total return of the S&P 500. Not capital gains, dividends, the boring quarterly checks that most investors overlook. So what exactly is a dividend? When you own stock in a company, you become a part owner of that business. And when that business generates profit, it has two choices: reinvest it back into the company or share it with shareholders. Dividends are that share. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have paid and increased their dividends every single year for over 50 consecutive years. They are called dividend kings. Through recessions, market crashes, wars, and pandemics, these companies kept writing checks to their shareholders. Not once did they miss a payment. That consistency is the foundation of everything we are about to explore. Now, here is where it gets remarkable. The concept of the dividend snowball is this: you take the dividends you receive, and instead of spending them, you reinvest them to buy more shares. Those new shares then generate their own dividends, which buy more shares, which generate more dividends. It compounds, like a snowball rolling downhill, gathering more snow with every rotation. Let me show you the math. Imagine you invest $10,000 in a stock paying a 4% annual dividend yield. In year one, you receive $400 in dividends. You reinvest that, and now you own $10,400 worth of stock. In year two, your 4% yield pays you $416. Still modest, but compound this over 30 years with the company increasing its dividend by just 6% annually, and your original $10,000 has generated over $117,000 in dividends alone, before accounting for any stock price growth. Here is another way to see it. The average return of the S&P 500 from 1994 to 2024 was about 10.5% annually. But if you reinvested all dividends during that period, your effective return jumps to 12.8%. On a $100,000 investment over 30 years, that difference of just 2.3 percentage points is worth over $750,000 additional dollars. This is why Warren Buffett calls compound interest the eighth wonder of the world. The dividend snowball is compound interest in its most consistent, most reliable form. Not all dividends are created equal. The biggest mistake new investors make is chasing the highest yield. A stock paying a 12% dividend sounds incredible, until you realize the company is paying out more than it earns, a dividend cut is inevitable, and the stock price is collapsing. This is called a dividend trap, and it destroys portfolios. So how do you find quality dividend stocks? First, examine the payout ratio. This is the percentage of earnings paid out as dividends. A payout ratio under 60% is generally sustainable. Under 50% is better. It means the company can increase the dividend and survive difficult years. Second, look at dividend growth history. A company that has raised its dividend every year for 10, 20, or 50 years is demonstrating something powerful: management confidence in future cash flows. The dividend aristocrats are S&P 500 companies that have raised dividends for at least 25 consecutive years. There are currently 68 of them. Third, examine free cash flow. Dividends paid from borrowed money are a red flag. Sustainable dividends come from actual business profits. Fourth, diversify across sectors. Healthcare, utilities, consumer staples, and financials have historically been strong dividend sectors. Technology companies are increasingly joining them. Microsoft has grown its dividend by over 300% in the past decade alone. No single dividend stock, no matter how reliable, should represent more than 10% of your portfolio. Let me tell you about a teacher named Linda from Ohio. In 1992, at age 32, Linda invested her $12,000 savings into 3 dividend-paying stocks: Coca-Cola, Johnson & Johnson, and Realty Income Corporation. She set them to automatically reinvest dividends, And then she did something that sounds almost impossible in today's world. She stopped watching. She did not panic when the market dropped 50% in 2008. She did not sell during the 2020 pandemic crash. She did not check her portfolio every morning. She just kept reinvesting her dividends, quarter after quarter, year after year. In 2022, Linda retired at 62. Those three original investments worth $12,000 in 1992 had grown to just over $847,000. Not counting the dividend income she was now receiving annually. Her annual dividend income in 2022 was approximately $34,000, enough to meaningfully supplement her teacher's pension. Linda did not beat the market every year. She did not pick the hottest stocks. She invested in boring, reliable companies, reinvested with discipline, and let 30 years of compounding do the heavy lifting. This is the dividend snowball in action. The lesson is not which specific stocks she chose. The lesson is that consistency, patience, and the power of compounding can transform modest savings into lasting wealth. Now, let us talk about what can derail a dividend strategy. Mistake number 1, selling during market downturns. When the market crashes, a well-selected dividend stock continues paying its dividend. Investors who panic sell, lock in losses, and miss the recovery and the compounding that follows. Mistake number 2, ignoring taxes. Qualified dividends and taxable accounts receive favorable treatment, but they are still taxed annually. Many long-term investors hold dividend positions inside IRAs and 401ks to shelter dividends from taxation, allowing every dollar to compound uninterrupted. Mistake number 3, not starting early enough. The difference between starting a dividend portfolio at age 25 versus age 35 is staggering. 10 extra years of compounding at 10% annually means approximately 159% more ending wealth. Time is the single most valuable ingredient in any compounding strategy. Mistake number 4, chasing yield over quality. A 10% yield is meaningless if the dividend gets cut by half next quarter. Always prioritize payout sustainability. High yield combined with rising payout ratios is a warning sign, not an opportunity. The dividend snowball is not a get-rich-quick scheme. It is a get-rich-slowly strategy. But in investing, slowly is exactly how the wealthiest people actually build wealth. Start with quality companies. Reinvest every dividend. Be patient, and let time do the work that no market prediction ever could. If this breakdown opened your eyes to the real power of dividend investing, hit subscribe. Every week on Market Mapped, we publish in-depth lessons exactly like this one, designed to make you a sharper, smarter, more confident investor. The snowball is waiting.